what's called alternative real estate, which basically is real estate broadly defined outside of, some of the major food groups, but we'll really talk about anything real estate related. Just real quick, I'm Ross Weiner, founder of Gemsco Capital. I manage a private real estate investment and advisory platform that's primarily focused on commercial real estate, and I invest on behalf of certain family offices, high net worth investors, other funds, and JV partners. I look at equity and debt, also involved in alternative areas like venture capital, special situations, private credit lending, and single family rentals. With me today is Ron Davari, right next to me. He's the CEO, co-founder of NewOak Capital. NewOak looks at advisory investments, structuring, investment banking, finance, and impact projects. Ron has an interest in sustainability and ESG and capital market solutions related to that, and he'll talk more about that. And on the end is Brian Kang, who came all the way from LA to join us. Brian is the chair of Greenberg Glusker's real estate group. They're based in Los Angeles. He brings a wealth of expertise to a broad spectrum of real estate transactions, including acquisition, disposition, financing, leasing, et cetera, all different property types, great clientele, and he'll tell us more about that. So just to give a quick just overview on some big picture thoughts on as the real estate, we've been doing this panel for at least the last year that Marty keeps inviting me back, and it's almost been sort of the same mantra. We have to wait and see. We went into this whole period of rising inflation and rising interest rates. Inflation's been dropping, but we had a relatively bad versus expectations inflation report this morning that kind of took the public markets down and interest rates shot back up. The 10-year is closed today at about 4.31%. It was 4.18 yesterday, but that's, still relatively in line where we were in December and September. But everybody was expecting the Fed to cut rates 3 to 6 times. I mean, the 6 times this year seemed a little crazy. 3 times seemed maybe realistic. But with today's report, maybe people's expectations are now being pushed back to the summer of this year, not March, not May, looking at July, possibly at the earliest. And obviously, high interest rates have a big impact on real estate. It affects borrowing costs, affects cap rates. Interest rates go up, real estate values go down. And we've been watching really for the last year to see when, rates are going to come down. Inflation's cooled off, but they're not really where the Fed wants to be or needs to be. So that is kind of affecting, sort of the markets still. I know people are going to start asking about New York City office. We can talk about that in the Q&A. And with that as just a sort of a brief overview, I'll turn it over to my panelists. Ron, you want to go first? Tell a little bit more about what you're doing and how some of these macro factors are affecting your view. Where do you expect?
Just a bit of warning. I try to look a little bit farther than what's just next. So that's been my entire life and my career. So a lot of these things for me is like little waves, and you really want to catch the big ones. And real estate is obviously, we look at real estate not just what you traditionally have looked at, but is a underwater forest, man-made, to impact the environment. Let's say Ibiza, that some of you may have visited. Or is that a real estate? Is that long-term asset? Is that something we should be looking at or not? Or is that needed? So I think, we know we live in Earth, and we need to keep it sustainable, and we need to make it operable. And that means, people who know how to impact and bring value. So it's not just land. Great Green Wall of Africa is another example. deforestation turned into forestation, creating community. So in that regard, I think, people who look at real estate as an operating asset rather than a dead weight sitting, in the middle of New York City, and that's the only myopia they have, then obviously that's not, please don't talk to us, because we have plenty of people who can tell you what's happening in New York City. But if you're looking for, big wave, big impact, bringing big dollars and big, complex projects put together, in a sense that you get both dilutive or non-dilutive finance coming in and making other impacts is something that we have our eyes on. And the reason we can afford doing that is because we have succeeded in other places. So we're trying to effectively live our dream, if you will. So that's really what NewOak Capital is all about going somewhere where the hockey puck is going, not where it is. And tenacity is one of our attributes. Go back to this, the Super Bowl game. I think Kansas City proved that tenacity is important. Stay until you win. And that's what we are trying to do. So that's really where we're coming from. Well, we are looking at, there's a huge amount of value in permanent capital. People look at funds, but, I've lived, primarily in debt and permanent capital while I was at BlackRock. And I found out, that blending debt, cheap debt with all sorts of additional layers of, tax break, creating jobs, affordability. As we know, there's a huge trend. Let me give you another trend that I'm really watching is de-Chinization of industry, right? There's Asia opportunities, there's India opportunities, there's certainly opportunities in the US for bringing industry back. One of my biggest fear was the semiconductor industry was leaving US, and I had a mezzanine loan in Research Triangle, right? And I had to watch IBM closing their, semiconductor factory, and I had to live through that in one of my commercial mortgage-backed areas. And I learned that that same exact space had a lot of 10 other uses that I didn't even think about, right? So, but that is coming back. You're seeing industrialization. You're seeing, robotics and other things will bring back multiple usage to the real estate that we're currently working. This space is not, it's an event space. You're seeing that there's a huge amount of real estate going toward dedicating to just event. So anyway, I'll stop with that. That's the way I look at it. Opportunities that are not yet funded and entrepreneurs that are willing to put their energy into it, and we help to fund it.
Thank you, Ron. Again, as Ross said, my name is Brian Kang. I'm a real estate transactional attorney at Greenberg, Glusker. Been practicing for a little over 20 years, so I've seen a couple of real estate cycles come back and go. Appreciate being here. Thank you for the snow. That was a great New York experience. I'm glad it ended, so we can walk back home or walk back to my hotel at least. So in LA, at least on the West Coast, I've been on several of these panels in the last few years, and the mantra has been survive till 25. And I'm guessing it's going to be a little bit beyond 25 at this point. The real estate market has about $2.2 trillion worth of debt coming due in the next 3-4 years. And there's a lot of questions with the rising interest rates as to how those debts are going to be refinanced. About $500 billion was refinanced in 2023, but a lot of those were workouts and extensions of loans, not actually payoff of loans. So those are still hanging out there. A lot of our clients are high net worth private family offices that have these kind of assets. But I'm actually optimistic. Right now, because we're a mid-sized law firm, we're able to do a lot of leasing work, retail leasing on both the tenant and landlord side. And frankly, because the finance work and the acquisition disposition work's kind of dried up in the last few months, leasing work has been keeping us very busy, which means that alternative retailers like Warby Parker, like the e-retailers are actually finding more brick and mortar spaces, as well as electrical charging companies. In California, as you guys know,
Yeah.
by 2035, all new vehicles have to be zero emission, which means that they're building out electrical charging stations all over the state. And that's a whole new, sector of retail that we've never experienced before. I'm currently negotiating a ground lease for one of those, and no one knows what's going to happen. It's a 30-year ground lease, and they want these turn rights. And I'm telling them, look, 20 years ago, there was no such thing as electrical charging station. I have no idea how to, calculate the loss or the risk that's involved. So it's really exciting. But again, it is kind of right now, it seems a little pessimistic because of the interest rate situation and the recent inflation rates that were reported today.
Thanks, Brian. I forgot about Karim Babay sitting behind us on the
Hi.
screen. My apologies
No
for
worries.
forgetting to do the intro for you. Karim in real estate as a family office, and they invest as GP through their family office. They're asset agnostic, and they look at special situations. They invest their own money and also invest as co-GPs with other investors. I'll keep that short, let you elaborate on that some more, Karim.
Sure. Thank you. Thanks, everybody. My name is Karim. I actually be the capital allocator mostly on the liquid side over the last 20 years or so. The last 7 or 8 years was mostly on the illiquid side / real estate. And as you know, we usually take a very contrarian view what the consensus of the market is. And I think that's where we can generate alpha for ourselves and so our co-GPs. We approach real estate because of the nature of our capital allocation agnostic as a bucket that needs to be, we don't have to allocate per se, and therefore any real estate investment that we look at, it has to be benchmarked on a risk-adjusted basis. Obviously, I won't bore you with the details around the consensus that you can all get a sense of from reading the news or watching CNBC. I think we have a major refi issues over the next 24, 48 months at least, but we still see opportunities. We bucket opportunities on an IRR range of 15 to 25%. I think since the topic of this panel is alternative real estate, one of the things that we are exploring is really providing liquidity for an asset class that is not really known to be liquid for our LPs and co-GPs. We are currently looking at a couple of investments in Texas. One is actually a multifamily. The other one is in the industrial space. Different risk-adjusted profiles. The biggest concern and the biggest hurdle for us as well for our co-GPs is getting our arms around not the underwriting specifics of the deal, but the liquidity around it if our investors, whether LPs or GPs, wanted to get out, before, the typical 5 to 7 years terms. Due to the nature of my background, I have both a combination of background in investing and also in tech. I recently exited a health tech company. We are deeply involved in blockchain, and we kind of exploring an opportunity to create the liquidity vehicles that runs in parallel to our GPs, LPs, to provide, in essence, to bypass the secondary market for some of our allocators should they decide to realize. And this falls right in our wheelhouse because by default, I grew up in an industry that favors more liquidity over, a longer holding period, such as private equity. So that's the angle that we're exploring.
Do you have any specific return targets that you're looking for in your investments?
15 to 25%. We actually currently, if we're looking at an asset class that is fully stabilized, that has a tax abatement in one of the major cities in Texas that offers this returns profile.
Okay, Brian, you mentioned that, there's still maybe survive till 25, which is a good mantra. I remember when it was stay alive to 95, but that rhyme always comes in every 10 years. There's certainly a lot of people feel that there's a couple $1 trillion of real estate debt coming due over the next couple of years. I think the last number that I heard was like 650 for this year ballpark, and then the rest next year. And, you know, I try and get clues as to where the market and where the puck might be going by listening to some of the REIT CEOs in terms of their earnings reports. And I listened to a couple of interviews this week with some major CEOs, and they were completely opposite each other. One was like, the 2 trillion's coming due and we have to wait and it's still going to be a difficult time. And the other is like, historic opportunities abound.
I think the big difference is whether you have dry capital or dry powder or not. I think those are recent Wall Street Journal articles saying there's an influx of a lot of cash right now into those distressed assets. We happen to represent a public REIT that's very specialized in industrial properties, and they were going gangbusters during the pandemic, but they're still very aggressive. They're still looking for opportunities. They're looking for ways they can just leverage the distressed market that's going on right now.
Now, that's a good point because, you know, there's still a lot of capital floating around, you know, and some of these big funds. One of the companies I was referring to, I think, was Scott Reckler's company, RXR, and they were doing a joint venture. I think it was with Ares Capital, and they raised like $3 billion to chase some of these opportunities. And then the other company was also another public company, and they also have a big pile of capital that they can deploy, but they're still being very careful as to how they go forward. And, you know, just every time I talk to, you know, some of the investors that I work with, I still get a lot of, we're still waiting. You know, people have money, but it's not burning a hole in their pocket, and they're being very selective. And the other thing is that even though some of these companies have capital and access to capital, they also have problems in their own portfolio that's taking a lot of resources for them to resolve and work out. And, you know, there was one of the big companies reported earnings last night, Vornado. And Vornado, I guess, is one of the owners of this building. And they just announced a deal. It sounded like a very complicated deal, and I didn't really get into all the details. But Citadel is a big tenant here, and there's another company involved with them, and they're master leasing the building for 10 years to Citadel for a big number. And I guess this solves some cash flow issues for Vornado. And then longer term, there's a potential development opportunity with maybe this property, but also a couple of others in the neighborhood that were part of the deal.
So, you know, I have a lot to fund managers. I would say like in the venture world, probably have fund managers, we could say not to right? And the people who are still in business are having a lot of fund. So they create more play. You think something similar is going on in real estate where people are just gonna, you guys think people just dropping out, like saying it's a really bad environment, I had a fund, I'm gonna just get back to money and keep on going?
Well, you talk about entrepreneur types or institutional type? I guess it's kind of a mix. I mean, you know, I spent a good amount of time over the past, you know, year helping a startup company raise money, and it was into the whole challenging environment that we faced, and in dealing with some of the bigger investors. A lot of them had money, but they were very, again, like they were just sitting on this, like, we're going to wait, you know, this is very interesting, but we have problems or whatever, we're a sideline, we don't have a rush, maybe later this year we want to do something. So you see some of that, Marty, but I think people in the business, they want to try and figure it out and do something and think that they can find that diamond in the rough or opportunities that make sense. So they're not going to shut it down, but they may proceed more slowly. I kind of fall in that realm.
No, I have a comment because I left BlackRock right in 2008, following the dream of distressed real estate. in the end, we went into technology rather than, because the opportunities in really scalable, institutional quality assets. It's a nanosecond. BlackRock, Blackstone, big insurance companies, when they start allocating, the market for smaller guys evaporate. Because, you can't get, if you can't get scale, and, you end up with, taking the crumb, if you will,
Well,
and not being able,
there's room in smaller size deals that the big guys won't.
I'm sorry.
There's room in smaller deals that the bigger firms won't touch. I mean, I know plenty of investors, for
Yeah.
example, saying, I won't look at a deal, below $100 million.
Mhm.
And, that leaves room for the $20 million transaction, the $30 million transaction.
We both have BlackRock and PIMCO, and all of them have made alliances with smaller operators who gather that, single family rental or flipper loans. There were a lot of small little guys that were just buying a home and flipping it. All of a sudden, Blackstone came in with, a $20 billion into the market and paid up a premium of 30 points to things that we couldn't even bother, because we didn't have the capacity to stay that long, and our investors wouldn't be able to do that. So that, I know there are smaller deals, but they're going to a developmental state. And because, if they do have, the feeder funds, they have a lot of different, I'm not a naysayer, but what I'm saying is that you need to think of value add. What they're weak at is value add, right? If you're adding value to real estate, we heard about the affordable housing, Section 8. I couldn't do much in a big company in Section 8. And now, I was very pleased that somebody finally realized there's a huge amount of, value to bringing, very concentrated institutional style management to that. This affordable housing is right now. Los Angeles today is paying $600,000 per homeless homes. I mean, it's just ridiculous. They're paying developers to build. Go ahead. Yeah.
Maybe a different question is, what's the hot sector? Like, if we were during COVID, and Peter Lewis kind of predicted, hey, robotics enabled industrial, and then when we saw Amazon go and acquire all this industrial, which some of it sold later, if you were going to say, what's the good section to be in, or do we have a problem where real estate investors are cross collateralized, and so the CRE dilemmas are going to, cause a domino effect for all the rest of real estate, or will government intervention be needed? I'm just saying, I'm asking, what's the scale of it? I guess if the guy with the founder of Starwood, he said that he thinks CRE is in play for 30%, just correction and valuation, right? The whole market, right? So I'm just asking, so what does that mean?
Well, at least in California, I think the opportunities are still in the multifamily market. I think the need for housing is just tremendous. And right now, there's a lot of lag because just construction regulations, it takes forever to build anything in California right now. So much red tape, which is causing a lot of developers heartburn and just draining their capital. But I think also, like I said, retail, for whatever reason, so many leases are coming across my desk where people want to open up brick and mortar stores. Saks Fifth Avenue just opened up their flagship store in Beverly Hills, took over the old Barney's location. So again, I don't know, like, people want to spend money. By the way, this may end. I heard credit card balances are rising as well. So, but right now people want to spend money.
Sir, you had a question?
Residential, office space, et cetera. Look at transactions that are not in the typical market, another complete market segment. I'll give you an example. There are 22 spaceports here in the United States. Would you take a look at a real estate deal, which is really aerospace related, that are called PPFs, payload processing centers, facilities?
It's probably outside of my area of expertise, and personally, I'm like a real estate entrepreneur, so I don't have enough bandwidth to cover the gamut of everything, so, yeah. No, I'd take a look and see if I could figure it out, but yeah, I don't know what you guys.
Can I give you one example? Right now, if you want a high return, non-interest rate sensitive, if you go to Southern California and you just take just get an entitlement on a new building, a new area, which is industrial for affordable housing, and be able to get entitlement and then get a building permit, and just go through that process with an option from the landlord, you made actually 5x in your investment. Now that's alternative to me, right? You're creating a new, it's not sensitive, it's not capital intensive, it is capital intensive, but it's more value being able to get entitlement, to get engineering done, and to put it out. One of my portfolio managers has done that and made money.
I think we had a sports franchise thing. You listen to those guys, last time they spoke,
Yeah,
where they're starting these sports franchises in mid-level cities, right? And the point is, so if anybody knows Dallas, where they have, I don't know, Plano or.
Plano is a good
they have the
example.
Cowboys, right? And the people, the Cowboys, there's all the entitlements that were given for building shops and restaurants around that area. And one of the pieces of one of these soccer sports franchise company leagues is that mid-level cities will entitle you to all kinds of real estate properties to rebuild. I mean, is that an alpha generating process where you can be the first guys into, to build, a bunch of real estate and multi-purpose real estate around a stadium?
it can be, but you have to deal also with all the political elements that go along with that, and not everybody wants to do that. So it depends. I haven't looked at any,
The Plano, sports thing got crushed on his debt. He on everything, and then somebody else came in and stayed it.
I think building something like a stadium is, like you say, even if the city buys in, it's such an endeavor.
So the way the city built the stadium, you don't. But the city entitles you to develop all the land around the stadium.
Nice.
Typically, they're in opportunity zones. And so you get an entitlement to develop 2-3 square miles of land around that area.
yeah, you have to,
Happening, with the Clippers,
The LA Clippers are building a new, stadium out in Inglewood, but that I'm not sure of. It may be, but there's delays just in the infrastructure that's being built around Inglewood right now. They're trying to build tram systems to SoFi and back, but that's being delayed. So there's a lot of factors involved just building that one stadium.
That might be a caveat emptor.
Give you another example. In LA, if you take in Koreatown or near downtown and take 4 residential property, put it together, city will give you up to 7-story as long as you don't do parking lot. Meaning that you're not allowed to.
Incentivize you to build out 7 stories.
7-story, and you do, the homes that were going for like 300,000-400,000, now they're selling for $1 million or $1.5 million because of the height and the permit that you can get in an area that used to be limited. No, it was the city wanted to be flat. Now they want to be vertical. They build the transportation now. They want you to go to downtown and back and revitalize.
The same thing happening in Miami where they're rezoning everything.
Yeah, those are the opportunities. Right.
Yeah, I think there's a movement in LA to be much more like New York, where you have
Yeah.
retail and restaurants on the bottom floor and, residential above it. If you look at Koreatown right now, it's not the same place that was 10 years ago. There's so much development going on, but it's funny because just, a few miles down the line downtown, I think you guys may have all heard of the high-rise apartment complex that has graffiti all over it right now. I think it's Greenview Plaza. The Chinese developers just abandoned it. And there's a news report today that someone just parachuted off that building as it's done. So it's really, I know this is kind of mundane, but like location, because even we're going to talk about office spaces. Downtown right now in Los Angeles has a vacancy rate of about 30%. But 10 miles down the line in Century City in West LA, almost 97% occupied.
Because it's a fantastic city, such a fantastic city, and you've got all this real estate, like the real estate around USC. It's amazing real estate, and it's terrible. Like, they haven't, nobody has come in and revitalized it, et cetera. I mean, it's just like, it's stunning.
Yeah, I mean, USC is a client of mine, but what they've done around that area, I understand like a little bit further out, it's a little bit dilapidated, but what they've done immediately around their adjacent campus is pretty amazing with their, the village and the university schools, the stores that they have there. It's probably one of the safest places to walk around that area, because of the security and the infrastructure that USC's put in.
USC, the SMU, Southern Methodist, which is phenomenal, right?
Now, LA's got so much, you mentioned, the parts of it, I'm a LA born, I'm an LA grown up person. Inglewood, you wouldn't want to touch it. Culver City is now the coolest area, the Venice Beach. We were being asked to lend money to Malibu. We thought in a large homes, and it said, what is it for? They were giving monthly rentals for a one-night bachelor party for $300,000 per. So the vibe was buying it to rent it. So there's a lot of alternative use of. Go ahead.
Brian, have they killed Airbnb in LA? They killed it here?
They are. I mean, it's slowly dying down because it's causing too many issues and, causing rental prices to increase so far. Housing price, exactly. And I think the rents in LA have kind of stabilized to some degree, but that's not really good news because it's stabilized at the increased prices that's occurred in the last few years. So.
I have to say, if I could do it, I think that sharing economy actually causes all kinds of ancillary problems that nobody anticipates. Like we have all these Uber people who just park on the street, right, in temporary parking, and they clog up the city streets, right? I mean, I'm just saying it's all unintended consequences, but that same thing happened. Nobody anticipated Airbnb would come an asset class, right? So, Karim, can you talk about your strategy and what you're doing? Can you ask me to talk about your strategy?
Karim, did you hear Marty? He's asking if you could talk a little bit more about your strategy, what your interest is, what you're doing.
Sure. Yeah. I mean, look, I'm going to be very specific since you asked. I mean, we focus on high growth areas. Obviously, Texas is one of them. Because of the nature of, we think that the inflation in asset is going to lead into an inflation of cost to the asset owners. We specifically look for deals where we could be on the size of the state, the city, or the county. The specific deals what we're looking at in actually Austin and Dallas, actually both of them. We ought, that's why we're looking for liquidity in the meantime, because we have to hold these assets for 7-8 years because the counties have given us a tax abatement, which there's no taxes and state taxes in Texas, so property taxes could be very volatile. So this is one area that we would like to minimize, if not eliminate. And both deals in both Austin as well as Dallas are where the county is actually, in one instance, they're co-GPing with us in Austin. So there's a waterfall where they can get a 5% and then share of the upside. And Dallas, actually, they're giving us that tax abatement because the area there's such a demand for medium to low income housing, and that they're willing to give us that tax abatement if we hold the asset for 8 years without even them getting a piece of the action. The other specific deals that we're looking at is not multifamily units, is actually industrial, and it's in Houston, but it has a much higher profile, but we just still not comfortable with the credit of the underlying tenant. And in this instance, and this owned by private equity, that's a sell lease back. Tremendous cash flow, but again, the certainty of that cash flow and the risk that comes with it is leading us to question the validity of the cash flow yield. And we quite frankly looking for the private equity to backstop that lease, so we could eliminate that risk. And we call it risk one, which is the duration of the lease, and then what's going to happen post that for the exit. So these are very, very specific deals that we're looking at, and they just happen to be in Texas.
Thanks, Karim. Anybody have any particular questions that they want to ask about particular property types or returns or?
Here's an issue with the tax. I thought tax were higher for California with our fix. That's correct, or am I wrong? Can you ask
Karim, are taxes Marty was asking about taxes in Texas versus California on real estate. Do you have any, he seemed to think that Texas was relatively high. Do you have any perspective on that versus California?
I mean, we don't look at we don't look at California, but I would imagine taxes related to real estate, and it's a bigger sources of revenue for the state in Texas and in California, and so it just goes hands in hand to assume that taxes related to holding real estate in Texas are a big income generator for the state, and they should be higher. But there's an arbitrage there if you can eliminate that. Actually, they're higher and volatile. So if you can eliminate that risk from an owner's perspective as a capital allocator, then you can give up a little bit of return on the deal in exchange of steadiness of the income. But I'm not too familiar with California, but I can tell you that taxes are very high and volatile, real estate wise in Texas.
California, I mean, one of the benefits is Prop 13, which got implemented in the late 1970s. What it legislates is that once you buy a piece of property, there's only incremental increases in taxes every year, about a 2% increase any given year, until you do a major restructure of the property, remodeling of the property, or you sell the property. So if you hold on to the property, you do benefit from an artificially low tax basis for that property for as long as you hold on to it. The problem is because of that artificially low tax income that the state's getting, they're adding taxes in every other way they can. Los Angeles, for example, just passed what's called ULA, or a mansion tax, which says that for every property you sell that's over $5 million, you have to pay an additional 4% tax. For every property over $10 million, you pay a 5.5% tax. Sales tax, basically, yes. Other cities, Culver City, Santa Monica, San Francisco, San Jose, they've all kind of followed suit. So where you were paying a 0.4% tax, now you're paying a 4% tax on. So it really does make a difference on the bottom line when you're trying to do real estate transactions now.
How do you see the growth occurring in those areas? Or is there? What is the great growth? I mean, I think you said residential real estate earlier, but can you repeat the question so the audience online?
I didn't quite understand the question.
What's the growth opportunity in California when the business trends are negative, which I don't agree with, and cost of living is so high?
Question is, what is the growth opportunity in California because costs are so high? And businesses are leaving, people and businesses.
Jobs are-
No, and people, and you're gonna have more of that. I mean, Brian, you talked about the electric charging stations and the combustion, engine issue. I mean, all that stuff's gonna cause more outflow from California. I mean, what are they gonna do? Are they gonna ban that you can't drive a combustion engine car in California? Or do you just
I
go to
hope not.
Nevada and buy it and you come back home to?
I hope not. I still like turning the engine on. I actually don't know. I mean, I'd be speculating to say where the growth is. If I knew, I would be investing in that area right now. But I mean, there is a movement in California. There's a California Business Circle, which Google, Apple, a lot of the big companies are involved with, are pushing for a Taxpayers Protection Act. What they've been doing in the last decade is fighting these new taxes every time they come up. What they're trying to do now is pass legislation this year that effectively limits the way the government and the people can raise taxes. So anytime the legislator passes a new tax, it needs to pass 2/3 of the votes as well from the public. Basically, yes. So they're trying to limit the way new taxes are implemented because it is driving business out for sure.
In California, I think residential affordable housing and homeless are two major areas that there is, they're far from equilibrium, right? So these areas, but it does require a value add. It doesn't, you can't go, the strategy that was presented here would not work. What you need to do is go create new, essentially get entitlement, get redeployed, do the engineering and sell, and that conversion will have better than private equity returns.
Curious to see what the difference. Influx of people into the state that are not working, not earning that kind of living to be able to support that versus those that still staying that can. What that spread, how is that changing? Because that will affect growth.
Yeah, I mean, it is. I think the politicians haven't quite grasped that. I mean, you'd have a better sense on the political environment in California, but from everything that I see from here, they have, the agendas that they may want growth, some may not, but, they're not going to get it. I mean, people are leaving for taxes, they're leaving for quality of life.
But the demographics don't support it though. The demographics don't support it.
What's
because
that?
You got 7% growth per year, right? I mean, you can't
Population is still
argue with
growing.
that. I'm sorry? Mexico.
My
Okay.
comment is that California has never had a shortage of entrepreneurs. The issue is the regulatory environment there. I don't think that after people come in and are not well educated, there's lots of not well educated people in California who have made fortunes, right? I mean, look, even though he was in New York, the guy that did the trolls was not a genius. Right? But he did
Actually, sorry, one other sector that actually I've been on panels talking about is modular construction. I know this is kind of a little bit off topic, but in terms of low-income housing, I think modular construction is one of the answers to it because it's just cheaper to build. It's smaller units, but it's cheaper to build and it's much more efficient in terms of time and regulations. And I think a lot of municipalities are letting modular construction in a lot easier now.
Is there a dialogue in California about restructuring office buildings?
There is, but actually I was looking into this. I think New York just 160 Water just turned into a residential unit, about 500 units, I believe. I think it's easier in cities like New York where the buildings are older and the footprints are smaller. In California, the buildings were built so the foot plates were so much larger. You don't know what to do with the center portion of the building. Because in California, I'm sure everywhere, each unit needs, a residential unit needs to have windows, access to open air. And if you have building plates where there's 20,000 square feet, they just don't know what to do with the middle of the building.
Mhm.
It is, yeah, there have been success stories like the Crosby in Koreatown, but it's really hard.
I think office is going to come back to work in a big way. I think there's just too many people living in the area.
Yeah,
You
it's,
probably
it's,
have better insight.
well, it's too soon to tell from everything that I see so far is that you have a dichotomy, right, between this kind of building, a location, and, and the B and C buildings. So the B and C buildings are really struggling. Yeah, in Manhattan, say, Garment Center type buildings, for example, older buildings with less amenities that are very costly to run versus, Park Avenue and 50th Street or Hudson Yards or whatever. Those buildings are very well leased. You got big companies, big law firms, investment firms, banks, moving there, or here you have, Citadel as part of this deal as a taking over, 850,000 square feet.
That's only right now about 20% of what the plan has.
But, you have to still look at, whether these buildings are getting used by the tenants, and the usage rate is still overall below 50%. But again, that's split between, older and newer buildings. And it also depends on how many more companies are requiring people to come back to the office. Now, overall, it's about 50%. Well, that's not,
I
that's
also think it
not what I
depends
saw.
on which
Well,
part of
that's
Manhattan you're
because
talking
the
about.
leases, so you have to recognize the leases were term leases. So when COVID happened, BlackRock could not, even though they were not using it, they had to pay for it. So you got to look at the lease term on each building and figure out when is the lease rollover. And that's what we do in commercial mortgage-backed securities. You look at to the end of the lease. It was mentioned by, because once that tenant is gone, then essentially BlackRock cannot get out of her lease because they did with Hudson Yard. So the buildings that were built in Hudson Yard, they weren't the ones that were already pre-leased. So about 50-60% of that plan still unexecuted. So they do have, if you look at the initial model of the Hudson Yard and what was actually printed already is a whole different thing. So there's capacity to add, and that's where they were hoping to achieve whatever they did, for example, with my own building in Columbus Circle, right? When they did the Columbus Circle, everybody at BlackRock said it's going to go broke. Nobody wants to do an indoor mall, right? And look at the utilization of that building today. Nobody wants to go outside anymore.
Well, but that space is different because it's mostly a showroom for the tenants. They're not really there to
Shop.
shop. I mean, there's some amount, a lot of it's tourists I live right around there, so I get to see this. But, a lot of it is they have the space, it's a showroom space, whether it generates money or not doesn't really seem to be the issue. They want to be in that location so that people can see their brand. But going on office space, I had some notes on New York City office. And one of the comments was this: New York's commercial market is being crushed under the weight of 20 million square feet of available office sublease space. Until that space is absorbed by new tenants, the market can't move forward. It's a predictor of the market. Sublease rents are generally 25% lower than the cost of leasing directly from the owner. These will undercut direct leases, and it's difficult for owners. Many can't and won't compete with the subleases. And that's going to be worse for the older buildings than if somebody wants to be in Hudson Yards, for example. But
Yeah,
Yeah.
again, I'm in a position that Class A buildings will do very well just over the long term because it's New York. And the older buildings will just be bought and torn down. New structure.
I think the buildings will do okay, but values need to come down. I mean, because of the financing costs and,
Somebody's gonna get-
yeah, somebody's going to take a hit. And you're seeing that. I mean, you're seeing buildings where the keys are being turned over, or you're seeing where they're being restructured.
But I think New York has fantastic intrinsic value.
We hope.
I
And it's-
agree. I
It's
think-
always come back. Let's put it that way. It's always come back. So until it doesn't, you know.
It's actually deregulation, right? That's what they always done in Connecticut. Whenever the market went down, they rezoned everything and said, hey, you can split your 2 acres of land into 1 acre lots, right?
No, I was gonna say, yeah, I mean, New York's in a much better position than the West Coast cities. I mean, you guys heard all the news about San Francisco. I think their vacancy rate's like 35% right now.
That's actually. it's really well.
I mean, it's kind of crazy. But crazy thing is, I'm actually negotiating a lease right now with the landlord, a big landlord in San Francisco. Their leases haven't changed. Their ball busting provisions are still in there. Yeah, you're just like, what reality are, yeah. But, yeah, so I think, and again, I think those iconic spots around the country, Manhattan, Century City, they're going to continue to thrive. I mean, in LA, the major law firms, the national law firms have a wait list for the associates who are in the downtown office to go into the Century City office because everyone wants to be in a certain area. So, you know, I think certain areas that are just hot are going to be very hot.
Any other questions?
Yep.
I'll keep on going, okay.
I think we've got, about 10 more minutes.
Okay. How
All
about
right.
Europe? Anybody looking at Europe?
What, I mean, there's a whole Europe regime. Karim, were you in Europe recently? I think,
Karim, were you in Europe recently? Marty
there's a whole-
seems to think you were.
There's like an ESG building.
I was, yeah.
If the building regimen is going on where they're trying to make buildings ESG compliant.
Can you talk about ESG compliance buildings in Europe?
Well, we
So
don't
some-
invest in Europe. I mean, we do invest in Europe, but we do not invest in real estate in Europe. So in terms of, we don't have any specific mandate when it comes to ESG related real estate. We specifically are very, you know, IRR focused. So, as opposed to perhaps Ron, who, you know, have that specific mandate, we don't, we obviously that plays into effect to look at the viability and the exit value of the building, as one of the factors, but we don't stick to it as one parameter per se.
No, he invests in other things.
Yeah, the ESG related stuff, I can make some comments on it because the opportunity in ESG and real estate comes down to the, pardon me, the reporting requirement that everybody is going to be subjected to. Pardon me, just let me shut this up. The reporting, so majority of building management systems today cannot provide you the adequate resolution to generate what is called the standard carbon emission report that are required, which has to be localized. It has to be use-based, meaning that, you know, if there's only one person in the same amount of lighting and 30 people, it has to be every 5 minutes. It has to be aggregated. And then, so commercial standard for the carbon emission, to the extent that that's a form of tax that is going to come around, so that you can't just emit and not pay for it. And so that's a little bit longer term. I think California is about to do some standards on that. That in that regard, Europe is ahead of us in imposing those taxes.
How do you support this? Climate issues in relation to real estate. How do
No,
you-
well, that's not an administration, that's local, that's the state level.
No,
Oh,
I
there
think
is,
it's state by state.
ESG reporting is,
Yeah, the Republic of California has their own regime as to what,
no, there
What,
is, each one,
we can do.
right now you're being rated. If you go into building, there's a
I
ABC.
mean, it's
But once it gets mandatory, every single real estate, no, if I go to, for example, if I ask, related, is Hudson Yard provide the reporting required for BlackRock to say that they're green? And BlackRock as a tenant can impose that on on the building, and that, you know, it's not just coming down from the top, you know, regulation, it's also going to come from tenants that need to abide with those rules.
Well,
So,
ESG's become not just you're talking about, I noticed that when you're talking about it, you're talking mostly about the environmental element of ESG. And to me,
yeah, right now it's the environmental.
it's, yeah, but it's to me, the E part and the S part and the G part don't go together. They don't mix. I don't know why they're even together. But there's been it's become a big political issue, ESG, and I think that was part of the gist of your question. And there's been a lot of pushback on ESG. I mean, BlackRock, which has been one of the leading proponents about it, Larry Fink has been recently walking back his views on ESG, and whether that's just a marketing, you know, kind of, you know, just we need to rebrand this so it doesn't irritate people as much. We'll just change the name. No, yeah, I mean,
One of the drivers for Larry thinking that, state.
Yeah, I mean, there's some of that, and there's, I mean, like, Moody's has been a big proponent about putting ESG in their ratings, whether clients want it or not. And there's been an enormous amount of pushback from those clients on Moody's that don't want this, as part of their ratings, didn't ask for it, and, Moody's, whether they'll admit it or not, I believe they've lost some business because of that. And so it's and Bill Ackman was just out over the weekend with a whole big, as part of his whole Harvard thing going on. He had a lot of comments about ESG and its relationship to DEI and what he didn't like about that. And I don't want to turn this into a whole political thing. So
I have a better question. What's the best real estate segment that you're not in right now that you would be in if you weren't in what you're doing?
I don't know what the best segment for anything is. I mean, that there is a best segment right now. Let me think about that. You guys?
I think actually hospitality has proven to be far more, people are a lot more resilient. They're spending money. They're traveling, whether they have the money or not, whether the interest rates have gone up. So you can see that, hotels are fully booked. And then there's also other revenue attached to hospitality that's going on. So again, a lot of people look at, it's not the real estate, it's what you do with the real estate at the end, right? You mentioned, Airbnb in LA and in California, they've already disallowed that. So what does that do? That means the hotels in California are doing better, right?
Same in New York.
The same in New York. But what I'm trying to say is that if you convert that to a monthly rental, that's a whole different story. It's the same rental, but it's just monthly, right? So we're trying to, real estate is no longer just location. It's use, right? And it's also looking at multiple ways you can earn from it. For example, if you have farmland, you take it out of the farming and reduce gas emission, you can sell the rights. People in Australia, they're doing that, right? The value is non-use rather than use, right? So. I don't know. I use data, yeah, I cheat.
Actually making use of all this, mall traffic data and every other type of.
Of course, we have a software called Mall IQ generated, used by Middle East and also in Asia. We are bringing it to Malaysia, and one of the biggest retailers, AEON, which is, if you are to Japan and in Asia, they're not only mall operators, but they also generate a lot of, e-commerce. The main thing is, as you walk into a building, your phone can be 3D outside of the Google GPS stuff. They send you a signal, if you walk into my Chanel store because you're two feet away. So as the technology is developing, you're going to be able to get more utilization out of your building. And, look, you're right. You mentioned about, the Columbus Circle Mall, right? I live there. I know every day I walk in there. I do believe that the tenants are getting their money's worth because the new ones are coming in. And why would they come in and put a new flag there, right? Because, foot traffic, is money. Data is money.
We've got about 5 minutes.
Yeah, sure.
Brian,
Yeah.
can you answer the same question? I'm sorry, what was the
Question is,
what's
where-
the best part of real estate to be in if that you're not in? So right now you're working on, office lease. Is there something better than that, or something that you would be in if you weren't an office lease right now?
Well, I mean, currently, again, office has picked up a little bit. I see office leasing coming across my desk more than it did in the last 6 months. Again, I think the one sector that really seems to be shining is just retail, at least in Southern California. And is just number of leases of retail leases from the small brands, as well as one of my clients is a Canadian grocery chain that's trying to break into the California market as well. So, I think a lot of people see a lot of opportunity to have a backfill for a lot of the big box spaces like the Best Buy or the Bed Bath & Beyond stores that closed down. I see a lot of those being backfilled by discount stores as well. I don't know if there's a Five Below out here. I don't know if there's a lot in the Midwest. Those kind of stores are actually backfilling as well. So I think there's just a lot of infill that's happening in terms of the retail space. I haven't seen any of those in the last 6 months or so, at least not across my desk. Not that it's not happening, but.
Karim, are there any real estate sectors that you're not currently in, that you would be in, that you see as attractive?
Yeah, absolutely. I mean,
What's the best sector that you're not in?
lodging, but I gotta be specific about lodging, right? As that we like select service hotels. I think the margins are much higher. We want to stay away from any food associated with hotels. So with select services, you're getting literally the 80% margin on a room without incurring the full service cost and the staff associated with a full service hotel. So these opportunities that we closely are looking at, we like the margins, especially if you can get a soft brand when you can still have some leeway with the way you can design your hotel and create a unique experience while benefiting from the distribution of the major brands.
And I guess for having thought about it a little bit, Marty, for me, it would be sort of high-end housing, both condo development and, more luxury communities, but, on a very selective basis.
Well, we're gonna send you send us an invoice.
All right, well, great.
All right, thank you, folks.
Thank you.
Thanks so much for making it. We're going to start tomorrow at 9:30 a.m. for Zoom, 9 a.m. for breakfast here. And we've got a great group of speakers. Really happy about it. And thanks so much for making it. And we'll close down online right now.
I would have logged it up. Sure.
Give me an idea.